What about you? Now that you are a little more settled, are you still like how active are you in Bayshore?
Bayline.
Bay Line. Why did
So
Bayshore is a road, right?
yeah, it's Bayshore Drive.
Yeah.
Um, so the simple way to put it is I'm involved. I was on a call with Patrick earlier around noon, texting with Ethan. Had another call with a broker earlier that was interested in trying to help out on this side of the business, and I'm like, probably not a good fit for Stockdale, but reach out to Ethan. So I'm involved. I'm just not there day to day. I don't need to do
Got it.
that hand holding. I don't need to say, go brass instead of stainless. Don't, left and right. I trust Ethan and Mark to handle the day to day. When it comes to raising capital, negotiating any of the agreements, that's when I'll probably take a little bit more of an active role.
Got it. That makes sense. And that's good because you're doing the important work that, is like the keystone, but 5% of the time you're not going to be negotiating important documents every day. So
Right.
it's smart.
And and I think it also gives me a chance to let Ethan and Mark run with it and see where they really do need help. And it's not just me. Patrick's there available to help as needed, especially on raising capital or just coming to a bridge and deciding, are we crossing it, or are we gonna go around and find another way. So it's a good team, and it's a good kind of approach to this. Um, but yeah, it's not like we're in the mix of a bunch of different things happening all at once, like right before I left Stonebeg. So that's also a benefit. We've got the time to be
That's,
able to do things.
yeah, that is great. And then what's going on at Stockdale?
So we've been looking at quite a few different deals. Even talked to a lender about buying something before they foreclosed. Went back, toured the property. It was in Dallas, and I said, "Let them foreclose. They're going to take a bath on this, and they're trying to position it to where they think it's worth the note value at par." And I'm like, "No, it's not. It's a discount to par." And so I'm starting to see more and more what used to be unicorns becoming the norm of, hey, this deal has a distressed capital stack. And 2 years ago, I told a lot of people, if you're looking for distress, you're in trouble because those capital stacks are in horrible shape, but the properties are fine. So
Yeah.
the people that would want to, exert pressure, the LP or the lender, are sitting there saying, hey, let's just manage through this. Property's fine. 2 years in the future, the guys that bought those with a heavy CapEx budget, well, they spent all their CapEx dollars on rate caps or debt service or paying bills, and it was never executed. And now those guys are no longer paying their bills. You've got distressed property. And we even see it in one of the deals that we did on the pref side here. The only multi-deal kind of in the portfolio is a pref deal. And, they bought a turnaround property in Austin that's not turning around.
Hmm.
And it's big enough, 400 and change units that, when you've got 30+% occupancy issues, it's a real number. It feels like a lease up, but you're leasing up a C property in a rough neighborhood. And it's exactly the profile that I don't ever want to participate in again. Um, and I think that's the key of me being here at Stockdale is I can look at that and say that doesn't pass the smell test. That was wonderful when the market would save you, but if the market's not going to save you, where's the real incremental return over buying something that's 10% off on occupancy instead of 30% off on occupancy? Um,
Yeah.
and maybe you don't let them just keep renovating to renovate. They get paid a fee to renovate. They haven't
But
been
you said
paid.
you're in the pref position there?
Yeah, but it's in a
So
prep. So we're in a prep position where at any
that
given
doesn't
moment.
sound terrible, right? I mean,
So
you can.
so what happens? They don't perform, and I have to take this over. Our basis is such that it feels pretty good if the property was performing, but if the property's not performing, I just stepped into a shit property in a shit part of Austin. I think that's the problem with the pref guys are they look at it and say, we're protected. Look at the capital stack. They paid, 150 a door, but our all in basis is 110. I'm sitting there going, yeah, but if you're 70% of that 150, you're 105. So our 110 doesn't feel that good, does it?
Yeah, that makes
Um,
sense.
and I think that's the fallacy of feeling protected with pref. Now, when you're buying something and you're saying I'm risking common equity for a 14 or a 15% return, but my pref is capped at 13, but I'm preferred, I get paid first. I get it. But a lot of the underwriting of the last 10 years showed value add in the 15, 16, 17, maybe 18% range, with a wink and a nod of, hey guys, this is really a 30. Let's face it, your cap rate's not expanding, it's compressing. Or the guy's going to put really good debt, or we're only going to do a certain amount of the work and we're going to sell the dream to the next guy and get paid for some of that upside. That doesn't happen anymore. And so for me, if I'm showing an honest to God underwriting of a 15, it's probably all the work I can get out of it to get to that 15. So with a 13 pref, your spread versus common isn't as great. But that also means that your downside is real.
Yeah.
And that's where I think you're seeing it with people going out for rescue capital. That rescue capital isn't showing up as common equity. It's restructuring the debt. It's coming in with pref. It's doing something, but it's resetting the basis to a level that truly gives that person comfort. And when those deals fall through, it's usually because the sponsor's like, wait a minute, I'm getting wiped out. Why would I do this deal? It's like, well, it's because you're wiped out. You haven't
Yeah, you,
recognized that
you
yet.
you don't have another choice.
Yeah,
You're drowning, right?
right.
Here's a life raft.
And even
You're
when
gonna
you
take
when
it or
you
you're
deal
gonna
with
sink.
those, yeah, when you deal with those restructurings, because we're doing it more on the office and the retail side right now, we're going to the lender and saying, hey, maybe we just take a B piece of your note, and if we're at risk of foreclosure, then we step in that way. So you
Yeah.
got $100 million property and you lent 60 million on it. I'll take the top 30% of it, and if we foreclose, then I can step in, but at least then my basis is 60, not 100, or my
Yeah,
basis
and
is
I
not
feel like
85.
those lenders too that you're working with, like they'll have more confidence that the business plan can be executed as anticipated by a real sponsor.
Right.
And as you said, you get in at a lower basis and they're not as concerned anymore. And maybe what they keep 50% of the full
Mhm.
capital stack, and you guys keep 10% from 50 to 10. And but is that what you're doing right now?
I'm looking for those types of opportunities, but on
Yeah,
the multi side, it's harder to find than it is on the commercial side.
yeah,
Um, I had lunch with our head of retail when I joined. I got to know him. I already know the head of office. We went to grad school together. Got to know the hospitality guy, and at lunch, I was telling him, I said, multi is a different animal than retail. We bought a distressed retail center at a 12 cap recently. Okay. Um, I go, the difference between a performing asset in multi and an underperforming asset in multi is a 5 cap to a 6 cap. Our band
yeah,
is so much narrower, and it's because of the resiliency of multi. I don't go from full to empty overnight. That doesn't happen. Even with ice raids or a factory shutting down or a military deployment, there's still a buffer there, and so I always look at it and say the resiliency is in the flexibility of your rent roll. But when your rent roll goes and starts to shrink, are we looking at it from a distressed perspective, or are we looking at it from a mark to market perspective? Because there's a little bit of both happening at the same time. Is that,
hmm
using that example of $100 million deal where the lender's in for 60, if we come in at rescue capital for prep and we lever it up to 85, our basis is 85. If we take it over, we feel good about that. To me, that feels like a mark to market play if we take it over. If we buy the B note and we take 30 of the 60, and we have to take it over through foreclosure or whatever, that lender's still going to get his 30 back. We're probably going to get our 30 back. Then there feels like a little bit more upside. And that's because,
yeah. Well, now
you're
you're
writing
at
it down
60.
40%.
Yeah,
Exactly.
exactly. Versus 80. So,
And so that's where, when we talk about, doing these deals in a structured way, um, I'm
but one's
looking at
much
it.
more combative, right?
Yeah,
Like
exactly.
when you're foreclosing on a borrower and the other you're more or less working with them to save their behind.
Yeah.
And that's why I would say it's more difficult to do the former. However, at a certain point, like any lender could who has the whole loan could just say, "Hey, I'm sick of this. Like I don't feel comfortable. I'm selling." Well, not anyone, right? You got to see what the terms say, but
Yeah. But, you know, I
top of
toured
Vino.
two assets in Dallas a couple of weeks ago, and I didn't like the assets. You know, that's the other
Yeah.
thing is I
Mm.
used an analogy, and I'm going to use this probably a lot with this team because we're very young, very aggressive. They know the markets, they know everything. When they're looking at a spreadsheet, they go on site, they look at it, and they're like, "Hey, this checks this box, and it checks that box." And I said, you're in a great neighborhood of Dallas here, okay? And you're dealing with a 2000 vintage mid-rise structured parking asset. All right, so you're checking all the boxes. So I'm going to use the analogy of cars. Everybody knows cars. Sometimes you use sports and people get lost in it, but I'm going to use a car. Um, I've got a fantastic in okay shape four-door sedan that's going to get you down the road just fine. And when you start checking the age and the your location and everything, you think I'm describing a BMW 5 Series, and I'm actually describing a Chevy Malibu. And no matter
Yeah.
how much money I put in that Malibu, it's never going to be anything more than a Chevy Malibu. Okay. And so just because it's built in 2001 and just because it's in a good neighborhood doesn't mean that it was anything more than just a good, solid, workforce housing type project. So unfortunately, I can't take a Chevy Malibu and throw a bunch of money at it and say, I'm going to now compete with all of the other 5 Series that are in this submarket because all of the other buildings have phenomenal amenities, better architecture, a slightly better location. And so that's the difference that I'm seeing. So it kind of speaks to everybody that chased 80s deals with the value add situation. If they didn't buy in a phenomenal location, how many people have just been putting lipstick on pigs time and time again, thinking that they're going to be worth more at the end of this? And I think we're at the end of the road of that kind of happening. You really have to look at it and say, unless I'm in a main and main type situation, or I'm in a pocket where an 80s vintage deal feels new. All right. I owned, when I was at True, the family office side, the Benedict Canyon side, we had property in Monterey, California. Everybody loves Monterey, California. It is heaven on earth. There's no employment there outside of tourism. It's a bunch of rich people. There's the golf course with Pebble Beach. It's just phenomenal quality of life. The newest property there that was not built by affordable housing groups was 1987. We owned it
Wow.
and we were growing rent 6-7% year over year because it was the newest asset in the market. Um, I don't know if you've ever worked with people out of Atlanta, Georgia. Um, so Sandy Springs, Roswell, that corridor. When was the last time anybody thought about building something in Sandy Springs or Roswell? Well, it's been years because they've got a moratorium, but it's
Hmm.
still two of the best school districts in the entire area. And a lot of the multifamily sites are massive units, 12, 13, 1400 square foot units. So I can put money into those units and dress them up, and I can improve the amenity space, and I can see the return for that because there's no inventory that I'm competing with. And even though the vintage is older, I'm at the top of the market.
Hmm.
But if I go down the road and I'm in Stone Mountain, Georgia, and I buy something in the 70s or 80s, good luck. It's a POS, both submarket and property. So why do I think that by spending 40 a door, I'm going to get a $200 lift for my efforts? It's not happening.
You're not. Yeah, exactly. It's interesting. Where do you think the market's going to take everyone in the next, let's say, year and a half? I've heard such mixed reviews depending on who I'm speaking with.
Yeah,
Brokers versus developers versus family offices versus lenders, right? I feel like everyone's looking at what's in front of them from a different perspective, depending on what more or less suits them best based off of their strategies, right? They're like, oh, I'm all in because of X, Y, and Z, and this is going to happen to me. And someone's taking the exact opposite approach, right?
hmm
On the other end of the spectrum. So curious to
So
hear your thoughts.
um, I tell people when they ask me about the stock market, what do you invest in? And I explain, I'm very old school. I'm in the real estate business, so of course I'm old school. But I'm an investor, not a trader. So if Ford is up one day, I'm not ecstatic, and if Ford is down one day, I'm not jumping off a balcony. Okay, I'm into it for the long haul.
Mhm.
What's it done over the last 5 years? What do I think it's going to do over the next year to 5 years? I haven't changed my philosophy from NMHC. There's been a lot of headlines that have happened since January, February. Tariffs, um, simple 12-day war with Iran just occurred that could have turned into World War III. Still have no solution for what's going on in Ukraine. India and Pakistan are still pointing nuclear weapons at one another. Um, so, in all honesty, there have been a
When you
lot of
put it
things.
that way, I'm sleeping well tonight.
Yeah,
There's,
sorry about that.
rainbows and butterflies
But
everywhere.
I take that geopolitical risk and I say there are so many different ways that you could have a black swan event happen right now,
Yeah.
that to really have to change my philosophy based on a headline seems silly. Um, do I think that there's still a tremendous amount of distressed loans in real estate? Yes, just like at NMHC. Do I think that we're in a regulatory environment that's allowing people to kick the can down the road still? Yeah. And until that changes, until LPs, until those pref and mez partners, or until the lenders say enough's enough, this sponsor is not going to turn this around. The market is not going to save you. And having Rise just recap a bunch of loans does not help with that narrative because they just had enough of a spread happen to where, with some rescue capital, they were able to get out from under a bunch of bad loans. I know that another group that doesn't have nearly as many issues is able to go through a 31 property recap right now and restructure some of their debt to where it's not a loss. And they're going to be able to work their way through it. So people will be able to work through it. The distress is real, but that means that right now I'm still a truffle pig trying to find that perfect situation to want to invest capital in this year. So if I'm not pressured to buy something right now, why would I unless I find the right opportunity? It's why the deals in Dallas, which could be great turnaround stories, if I lose it, I lose it, and I go on to the next one.
Yeah.
Um, and I'm not trying to just buy for the sake of buying, like a lot of firms, to generate fees. That's not the way we work here. We really look at the total return. We're trying to do what's best for the investor, and not just ourselves, which should be business 101 when you're managing other people's money, but it's not always the case. So no, I think that the next let's call it 6 months, now that we're at 7-1, is about setting ourselves up for 2026. Um, because in 2026, I do believe you're going to see a difference in how lenders are treating their bad loans, whether they start putting things into separate bad banks to deal with. I haven't seen that happen in a long time, but I have heard of debt funds starting to segregate some of their funds and saying, good fund, bad fund. Um, and so the more that happens, the more certainty you have in the market to be able to say, okay, good property, bad capital stack, let's go buy it. Bad property, maybe we avoid it. Great property is doing very well, speaks to why we're in the business to begin with. So we're still in the transitional period of becoming truly transactional again. And I think that does start to ramp up, but it's going to be more end of this year and into next. I also think that you're going to see a lot of Q3, Q4 executions of deals, especially for groups like us that can close all cash, where somebody's like, "Holy shit, I got to get this off my books by 12/31," and I think that wave is gonna start to hit.
Interesting. Why do you think it's going to start to hit now?
Um, because we do have a very favorable regulatory environment because of the chaos coming out of Washington, D.C., and their hatred of all regulation. But eventually people are going to say, okay, we're going into 2026. That means the midterms hit. And that means that if they don't control the House and the Senate and the White House and the Supreme Court, are you going to start to see cracks where the next cycle is going to be significantly worse? And where do we end up with a lame duck senator, a lame duck president, a lame duck Congress, where all of a sudden the regulators and the bureaucrats basically come back into play and say, now I can raise my hand again and say, your bank shouldn't be holding on to that bad paper, or hey, by the way, I'm the SEC, and there is this enforcement division where people who are lying need to be slapped on the wrist. I think that that's coming. And it's, again, kind of coming back to being a dinosaur. We move at the speed of geology, not the speed of nanotechnology. So you can't look at it and say, what's this month hold? What's next month hold? What's next year? What's the next, 2 or 3 quarters hold? Every decision that I make about a property and a portfolio doesn't really translate to results for 30, 45, 90 days at a minimum. And so if I'm trying to really see what's going to be happening as an industry, you're talking about, probably 6 months to a year at this point. But I do think that you're going to see more and more optimism. We saw more optimism at NMHC, but it was what they call it, cautiously optimistic. Um, in 2026, it's going to be time to shit or get off the pot. Because the other thing is just having, managed acquisition guys in the past. Um, I've heard the phrase, I'm getting out of this industry from several of them. I need
Hmm.
to go make money. I thought this was the path. But if we're not going to be transactional, um, what am I doing here? I'm losing kind of my prime, earning years, waiting for this turnaround to happen. And then anecdotally, on the asset management side, I know now of 3 very senior leaders on the ops teams of some well-known groups that are basically saying, I'd rather be retired than deal with this shit right now.
Yeah. Interesting. Do you think that'll create an opportunity for folks who are more or less my age to fill that vacuum
hmm
of individuals who have probably stuck a lot around for a little too long, right? I feel like when I look
just so you're aware, I might be in my 50s. The 3 people I'm talking about just turned 40
that
that
are
are ready to
leaving
leave.
because of because they're nervous on missing out on earning potential, or because they're like, I'm sick of this.
I'd rather go sit on a beach for 2 years and get rehired when I'm 42,
Yeah,
when people know what they want to do. But I'm
that's
tired of
interesting.
babysitting. Yeah,
See,
it's
because
not people my age.
yeah, I see a lot of folks that are 20 years your senior who are still in the industry. And it's funny, a quick anecdote. I was talking to this woman. She said her dad retired, but still goes to the office every day because he doesn't want to give up his corner office. Right.
hmm
And I feel like there's a lot of that out there still where you have these deal makers that are doing less and less deals and are more so remaining as figureheads, but it's their underpinnings who are the ones actually getting things done,
Oh,
not
all the
getting
time.
any, yeah, not getting any credit for it, which is just part of life, right? Like
hmm
you got to do the work and put in the reps. But ultimately, I feel as though, just I guess, in terms of how life is in general, people are waiting longer to get married, people are waiting longer to have kids. Back in the day, you heard stories of people getting very successful very early in their careers, or at least the ones doing the work were getting the credit. And now you're not really hearing people's names until they're mid to late 30s, early to
hmm
mid 40s, early to mid 50s. Do you think that's going to change?
I hope so. And here's why. I think that some of the gray hairs that sat on investment committee in 21, 22, 23 that killed deals because they said, guys, you don't know what you're talking about. These don't make sense to me. Saved a lot of companies. They really did save a lot of companies. They were
Yeah,
worth every dollar. Now, that said, a lot of the larger firms that we've dealt with over the years that were our LPs that have gray hairs on an investment committee that are killing every deal because it's a reputational risk. It's not their money on the line.
yeah,
Those are the ones that probably have stayed in the seat a little too long. But to your point, if I'm sitting there going to work fewer and fewer hours a week and my pay package is still high 6, low 7 figures, where's my motivation to leave? And if I don't have a strong CEO or board that says, thank you for all your service, we're going to move you to either emeritus status or we need to move on and put a new, younger leadership team in place. And it doesn't always have to be younger, it doesn't have to be age based. It's just you've got to have the right kind of alignment. But if you said to 25 firms on Wall Street right now. When was the last time you did a deal with either a sponsor or a direct investment? And they said 2 years, 3 years, 4 years. What have you been doing to earn your pay for the last 2 or 3 or 4 years? It's time for groups to say, okay, this is my philosophy. I want to be investing in real estate, and investing is both buying and selling, not just selling and holding. So I do think it's a great time for people to step up. What I will also say is several of the people that I've mentioned, several of the people in my previous shop are not going out to find work. They're going off to be third party consultants, similar to yourself, where they're going, wait a minute, um, X, Y, and Z person spun their company off from the one that we worked at together 5 years ago. And he now has 1,500 units or 1,000 units, but he's got, 600 under contract and he needs help. I can go help him. I can't make a job out of that, but I can do it as a 1099. But if I could put two or three of those together, I'm actually making more money and working less hours than I am if I'm sitting in an office.
And
And
that we're seeing a ton of that,
yeah,
right? The industry fragmenting a little more, the rise of the consultant, the outsourced analyst for us, but
hmm
you see it as CFO, CMO,
yeah.
asset manager, all the
Why
above.
why do I need a CMO if I need a marketing campaign designed and implemented and then just babysat? Why do I need a CFO if, I'm basically able to create a reporting package and then it's just being spun out every quarter for a less sophisticated LP base? Okay.
Yeah.
But more importantly, asset management was really the bastard child of real estate for 30 years. The acquisition guys are the deal makers. They're the rainmakers. You raise equity, you find deals, you close deals, you're done. The portfolio managers may have had a little bit of cachet to have some swagger to say, no, I have the ability to say yes or no, go, no go on certain things. And the asset managers just sat in the background and slugged it out and got things done. Um, the last few years have been the years of asset management where there haven't been a lot of transactions and firms are living and dying by their asset management capabilities. And a lot of firms that said, hey, I'm going to hire a couple of rainmakers and we'll figure out the asset management piece later. Those are the ones that failed. Or, hey, we're going to
Mhm.
rely on our third party property manager. It's basically the same, right? Because they have no idea. And that's why like the rise of that third party asset manager is kind of coming into play where, oh my God, I need X amount of AUM or fees or unit count to be able to pay for a good asset manager. Well, I can hire a great asset manager right now for a couple $100 an hour or, a share of a fee and have somebody looking over the shoulder. So I do think that you're going to start to see that on the rise as well.
Yeah,
And it's
and we're
because,
by the way, we're seeing a lot of these groups, they're mitigating their risk, right? Like if you have to work with a CMO, a CFO, an asset manager, yes, you can pay them up front, but if you're getting started or you're very lean or cash is very tight, it's hard to afford that. And it's also, you don't want to go to your LP and say you need more capital, but a lot of times groups say, hey, I'll just give you a percent of my promote. And then it's very much so risk aligned. If the sponsor doesn't do well, the other folks aren't getting compensated and they sign up for that, but they know that if the sponsor kills it, there's significantly more compensation opportunity available. And that's honestly how we're starting to structure our deals. Now that we're in a position, we have 5 people on staff. Payroll
Mhm.
was very important when we first started. We've built up enough of a nest egg where we're saying, hey, I'd rather lose out on 3 deals and win one, but that one deal is worth the value of 20 deals for us.
Right,
And then it's game over, right? So it's calculated risk.
right.
So that's what we're doing more and more frequently now with the debt placement arm, and we're trying to find more of those opportunities. As you
And
guys at Bayline continue building out, let us know if there's anything that we can do to put our eggs in your basket because we're happy to contribute eggs as
and
well.
I, that's what I was going to say is I think I introduced you to Anthony on the construction management side. I'm happy to introduce you to any of the groups that I know that are starting to spin off and do the asset management as well. It
I don't
becomes an
know if
ecosystem.
I don't know if I met Anthony. You introduced me to
Oh,
some
Ryan, I think I introduced you to Ryan.
Ryan. You
Yeah,
introduced me to Ryan.
so Ryan took another job, but he is doing something on the side with another guy, Jack, who just gave his notice on Monday at Stonebag. So, for me, if somebody's starting their own acquisition group, they're going to need help, whether it's on the debt placement side or deal structuring or analysis side. Um, a lot of these people that are spinning off and doing their own thing. Anthony is my construction manager from Stonebeg. He and the entire construction management group are moving over to their own, company. They're it's going to be called, I believe, Glacier, and they're going to be able to provide due diligence services upfront, property walks, creating capital plans, creating renovation scopes, helping people buy things out. Everything that you would have an in-house construction management guy do, or even a GC do, but they've done it so many times and they know markets all over the country that they can do it for a fee on a 1099 basis. And hey, I'm doing my first deal. I can't afford a construction manager. Now I have to rely on either my management company or I have to rely on a GC. Good luck with that. So it's hedging your bets. And the same is true with, like I said, I was going to say, as these asset management groups start to, pop up, happy to make that introduction, because what happens is you're a wealthy real estate investor that likes to run lean, or maybe you only do a few deals, every few years. You don't want a big staff, but I need help on deal structuring. I don't know where debt is today. I don't want to, be restless at night worrying about my construction deal. I don't want to rely purely on a property management report to execute my business plan. And all of a sudden that ecosystem comes together and says, well, why would you hire when you can take advantage of people that have experience at True America and experience at Stonebeg and experience with Alkaline, and be able to say, hey, you get the cream of the crop here without having to pay for it. So it's the same pitch as the CMO and the CFO for hire. It's just creating more of that ecosystem approach to say, no, this is what you really need. Because I ran a family office where the true family office itself was the family and three of us. We had a couple hundred employees, but the three of us really ran everything.
Yeah, that's mission control. It's
Yeah.
funny. I just met with a group. I don't know if you've heard of Edison Property Group. I mean, they have billions under management, and it's this gentleman who probably in his late 50s right now, mid to late 50s, trained under the patriarch of the family for decades. He passed away. Now, this gentleman is running the operation. There are four daughters that are inheriting the real estate that they're like managing to split it up over. And on his team, he's got three other individuals, like
Mhm.
one analyst, one government relations professional, and then I think an asset manager. That's it
Mhm.
for
Yeah.
billions of dollars worth of real estate. Now, of course, to your point, they have a slew of uh, hands for hire,
Yeah.
but that's at a project level. It's not really on the mission
Enterprise.
control board. Yeah,
Yeah.
exactly.
Yeah. So no, I see that happening again. And it's one of those, would people rather work for a company, have the infrastructure around them? A lot of people feel comfortable with that. Some of those companies offer that, but it's really not coming to fruition. And there has been a generational shift, whether it's work from home, or why do I feel compelled to work my 40, 50, 60, 80 hours in the office? I can do this gig on 15 hours a week and spend a little bit more time doing my own thing. Or maybe I take two of those and I'm at 30 hours a week and I'm making more money than I did when I was killing myself for somebody else. And I'm going to take 3 weeks off at Christmas time. Nobody's going to tell me no. So you're going to start to see, instead of that senior exec showing up in the office and just being there, kind of creating, in essence, a glass ceiling for everyone else, people taking control of their own destiny. And there's a chance that they leave companies and those companies turn around and hire them and say,
Yeah,
shit, I
as a
need you,
consultant.
because why wouldn't I go back and talk to, I'll use Stonebeg as an example. Your entire construction team just is about to leave, and you need help. Well, they'll probably collect a check from you just as easily. They're just not going to deal with your bullshit.
Yeah.
you know and I think
And,
that's really what it comes down to.
and the interesting part there too is they could pay the consultant who was an employee more than the employee was making before and still save money because they're not paying taxes, employment tax, they're not paying benefits, and it's good. It's better for everyone. Now, you don't
Yeah.
have the certainty of they'll ball and chain for 8 hours a day,
Mhm.
but at the end of the day, that's not what you want. At the end of the day, you want more of a meritocracy and democratic approach to, hey, maybe the best worker should be compensated the most and not
Right.
whoever is pretending to work the hardest or just the figurehead for the work being done behind the scene.
Exactly.
I mean, it's a new age that we're in, and it's pretty exciting. And then you have all this technology coming on board, and I still think people are very gung ho on AI. People bring it
Right.
up in every conversation that we have. I think AI is going to save a ton of time, but you're going to need people to manage the AI. You're going to
Hmm.
need people to still understand strategies and what's realistic and what's not to discern, okay, what's a good AI idea from a bad AI idea.
So you still have to have an element of critical thought. You can try to build it up front into an algorithm that allows AI to go fulfill the algorithm's needs. Or you let them bring you all the information possible, but you still have to have it distilled either through a body of people or an individual's mind to be able to say, this is what decision we're going to make. AI will not make the decision for you because if you turn that decision making process over, then you've lost positive control. Now, on simple things, do I, have coffee or tea? And if AI decides you look like you're having a tea today, it's probably not going to move the needle very much. But if I'm going to trust AI to say, do I need to go on medication? Do I need to go to the hospital? It's probably a decision that I need to start thinking through. When it comes to investing, do I trust AI to get me every available market data, snippet here and there? Absolutely. Do I think they can synthesize that into a coherent investment thesis that tells me yay or nay on a property before I even look at it? No, not yet. So we're still several years away from it being able to add that layer of critical thinking to a point where it does truly replace people, particularly well experienced people. What it also risks then is that legion of analysts and associates that have to spend the time to build up that experience to the point where they know what they're doing to make a decision. If you start taking those jobs out and supplementing them with AI, then you've got a problem because half a generation from now, when I'm retired and you're in the driver's seat and you look around the table at your analyst pool and you go, wait a minute, you people have never even, had to call around and talk to a property or learn how to shop comps or do anything because AI did it all for me. What are you really doing? What are you really, relying your decision making paradigm on? Because it's not going to be the people around the table if that's the case. It's going
Yeah,
to be how well was that algorithm designed.
agreed. A lot of stuff to digest, a lot to
Oh yeah,
unpack, and things are changing every second.
every
So
day.
I'll let you get back to it. This was a great one.